You're judged by these tiers that are going to approve you or not approve you. I'm here with Patrick Brenner. Patrick, how you doing?
I'm well, Philip. How are you?
I'm doing great. Good to have you back.
Likewise. Thanks for having me.
Let's unpack these credit tiers, starting with the top, and
Sure.
what these tiers are, what they mean to the consumer. What does this mean for approvals, for credit limits? Just let's unpack one by one, starting at the best.
Everybody's heard of a FICO score.
Yeah.
And that's a score that is provided to both a would-be borrower and a would-be lender. And it is provided by the Fair Isaac Corporation. It is an assessment of risk. But it's not just a measure of risk. It's also a number that determines which financial universe you as a borrower are allowed in. So when I think of credit scores, most Americans think that credit is like a single ladder. Improve your score, get better terms. But in reality, credit is it's a set of gated communities. Some gates are wide open and others are not. And the biggest policy mistake we make is pretending that those gates don't actually exist.
Okay. Wow. I like the whole private gated communities.
Yeah, yeah.
I've never thought about it like that. So let's start with the best, right? What's
Let's
the
start at the
highest credit
yeah.
tier?
Yeah, let's start at the very top in the most exclusive of the gated communities. That is tier 1,
Mhm.
Subprime. It's a FICO score of about 760 to 850. So that 3-digit number that you get from FICO,
Yeah.
the 3-digit number that you get from the bank, everybody knows their FICO score. Mine's in the 700, something like that. Tier 1, Subprime. That's very top. These borrowers don't just get lower rates, they get structural advantages. They get pre-approvals, they get zero-fee products, they get
Mm.
rewards that are subsidized by all of the other tiers. Lenders compete for these borrowers, not the other way around. So people assume that this group benefits from consumer protection laws, while in practice, many regulations actually entrench their advantage by punishing and pushing riskier borrowers out.
Does this mean things like you don't have to verify your income and, you don't have to prove various things in the application process? I mean, when you say pre-approval, it's a true pre-approval where it's like, hey, here's $25,000 line. You throw it in, you're going to get it, or is there still a qualification process?
Oh, there's still absolutely qualification process, and lenders are required by law to collect all of that information and verify income. So they're not skipping out on those qualification requirements. It just makes it easier for the pre-qualification to come through.
Okay, got it. Okay, so it's just this super prime, as you call it, is easier qualification process, although you still got to qualify throughout the process or for your credit. And you get better structures, probably better rewards. This is where you get the litany of benefits that you see advertised on these super prime credit cards.
Everybody's heard of Amex Black,
There
American
you go.
Express Black. That's the card for the super prime borrowers. Yep.
Got it. Okay, let's go to the next tier.
I think most people think of this as normal credit. This is the range by which a good percentage of borrowers fall. This is tier 2 or prime. The FICO score range in this tier is about 680 to 759. So this is the normal credit tier. This is where a good majority of borrowers actually fall into that bracket. In this tier, these prime borrowers still have access, but there's less margin for error. One missed payment on a borrower's credit report changes pricing very quickly.
Okay.
Pricing that is extended to the borrower. Lenders price for volatility, not just default. Something else that is important to notice about this tier is that prime borrowers benefit where some prime borrowers exist. And why is this? I mean, it's risk-based pricing and it spreads costs around and keeps products viable. When lawmakers say this will only affect high-cost loans, referring to this tier, prime borrowers eventually see tighter underwriting, fewer product choices, and higher fees replacing interest that's charged on the product.
Okay. Like break it down into simple language, what you just said.
Tier 1, no questions asked. Tier 2, some questions asked.
Okay. So when you have a late payment, one late
Yes.
payment, they're going to look at that and you may drop you from the super prime to the prime. Will the interest rate be different between the two primes?
Yes.
Okay. Will
certainly.
the annual fee be different between the 2 primes?
Sometimes it depends on the product.
Okay, depends on the product. Okay. So it's a deterioration of the product in some capacity, whatever that is, depending on the product. So maybe even the rewards are a little bit less on the prime versus the super prime.
Right.
Okay,
Right. Yeah.
great. Next tier, next secret tier.
Well, this is another good one. Near prime. This is tier
Okay.
3. Typical FICO score range of 620 to 679.
Mhm.
And this is where the story changes. And this is where most of the debates about consumer credit access fall apart. Near prime borrowers are often recovering from a disruption. This could be a medical disruption. They're paying for um, health procedures that went to collections, possibly. This could be a result of a divorce. A divorce puts you into this near prime category. And
Mhm.
everybody incurs unexpected expenses in during and in the aftermath of a divorce. This could be caused by job loss. I mean, there's all these other factors that could be contributing to a borrower ending up in this category. But what it's also a signal of is generally these are individual borrowers who are actively climbing back up into prime and super prime. This tier is most sensitive to government regulation. This is the group of borrowers that government policymakers think they're helping, but restrictive price controls or other credit regulations actually end up hurting this tier the most.
Okay, so when you say this tier has the most government oversight, or I forget exactly how you said it, the most
Well,
how
it's
did
not
you
quite government oversight. It's not as though the government is overseeing
mm,
individual tiers of
mhm.
borrowers. It's rather that when government gets involved and starts implementing regulations in credit markets, this tier is the one that's the most susceptible to changes.
Okay,
They're the most fragile.
and that means that the government's gonna come and say, "This tier, you cannot charge X number of dollars for," or this are they gonna limit interest rate? Is that what the government would do?
Yes. So a great example is there are two senators, Senator Josh Hawley and Senator Bernie Sanders. They have introduced a bill. This is a bill that is intended to cap the interest rate allowed on credit cards to 10%. It is a national bill. That bill,
Josh
if
Hawley
implemented,
and Bernie Sanders
I know.
co-authored that bill?
Yes.
Huh,
There's a
wow.
companion bill in the House. That's Alexandria Ocasio Cortez and her compatriots. But it would set a 10% cap on credit cards. Now, this borrowing tier, the near prime, they would be most susceptible to a bill like that. Credit would shrink,
Well,
contracts would tighten.
when you say susceptible, they wouldn't be approved for those credit cards.
It
If that near to prime tier had a maximum interest rate of 10%, they
Yes.
just wouldn't approve them. Those people.
Well, it's not just a 10% cap on just the near prime borrowers. It's a 10% cap, period.
Okay.
And
So
if that
anyone in
10% cap,
near tier and below,
they
the
wouldn't get it,
approvals, yeah, they're not gonna get it.
right? All those credit card offerings are going to go away for everybody except super prime and prime.
Yeah. See, people like this is my what I hear over and over. I hear, the interest rates are too high. I'm like, it's not too high where you're gonna have a credit card for 12 months or 24 months. It's a rebuilding process, right? And this is what I'm hearing in the near tier. The one thing about the near tier versus a lower tier is at least they give you credit and it's not like secured in some capacity, like a
Sure.
secured card.
I
So
think the near prime borrowers can generally accept that they will, on certain conditions, be able to apply for unsecured credit lines.
below near prime, what's next?
This is tier 4,
Okay,
subprime.
subprime.
The FICO score range for this tier is 580 to 619.
Okay.
Now we enter the tier that policymakers, government officials, bureaucrats, politicians, they love to talk about this tier,
Mhm,
but they rarely understand this borrowing demographic.
mhm.
The demand for credit within this borrowing segment, this demographic, it doesn't disappear. There is still demand for credit. There is still demand for credit because these people are the most susceptible to day to day fluctuations in income or unexpected expenses.
Mhm. Yeah,
Those unexpected expenses sometimes require financing, you
yeah.
know,
I mean,
$500 for new
unexpected
tires.
yeah, when you say unexpected expenses, you're talking because this type of borrower typically does not have the money in the bank to pay for the blown tire, right?
Correct.
Right?
Right.
Doesn't have the blown tire, so what are they gonna do? They need some type of credit, and these are the borrowers that many time go to buy here, pay here, or like you need a TV, instead of going to Walmart and getting the lower price, you go to a place where you pay by the week for the TV and pay it 3 times the value, right?
Right.
Yeah,
Over the life of the loan.
you're over
Sure.
the life loan because they don't have the credit available like you're talking about.
Right.
Um, and what
And
else
they just
about
they
yeah,
can't get access to the typical credit that is offered to the other tiers. They don't have access to the typical mainstream banking institutions. A lot of these borrowers would probably be classified by the Federal Depository Insurance Corporation, the FDIC, as unbanked or underbanked.
mm,
They do not have access to mainstream credit options or even mainstream financial institutions, and either that's by choice or by unfortunate financial circumstance.
yeah, I get it, I get it.
They are susceptible to late fees. This demographic is most susceptible to utility shutoffs. They're most susceptible to having to rely on informal borrowing or illegal lending. They're most susceptible to be evicted for inability to make rental payments. And
Yeah,
it's this category. It's not about irresponsibility. A lot of these borrowers are not irresponsible. It's just about volatility.
yeah.
They're unfortunately put in this demographic. They're unfortunately assigned this tier because of unfortunate circumstances, a lot of times beyond their control.
And this is where also the people have to apply for secured credit cards because they don't have the access to credit. They have to buy for secured credit cards. This is where our students, many of them, when they're trying to rebuild their credit, it's like, no, don't worry about it. Get this secured credit card, put $100, $200 in that card, and then go from there.
Let's talk about what a secured card is. This is where it's there's secured credit versus unsecured credit. Secured credit just means it's tied to collateral, that credit line. So in the case of an auto loan is an extension of a $30,000 loan, and it's tied to a vehicle that was purchased at that $30,000 mark, right? The loan itself is tied to the collateral, and it's less risky for a lender because a lender can repossess the asset in the case of default or non-payment. Same thing with credit cards. How do you collateralize a credit card, though? A lot of times in the secured credit card space, all that's required is cash down. So you put $500 in cash into an account, and that's held in an account that you can't touch for the duration of you holding on to this secured card. And a credit line of that same amount is extended to you. So you put $500 into a secured card, and you get a credit card that has access to a $500 credit line.
Okay, so that's subprime. Is there
Yep.
a tier below subprime?
There is one more. There's one more tier below subprime that is called deep subprime. That's tier 5.
Okay,
These are FICO scores that are below 580.
okay.
And this is the tier. As a policy analyst, I'm going to talk about it from my perspective as a policy analyst. This is the tier that lawmakers pretend don't exist. These borrowers are generally excluded from banks. These borrowers are generally excluded from credit unions. They don't have access to a lot of mainstream financial products. The question is not whether they borrow, it's from whom and at what cost.
Mm.
And at this level, it's really key to identifying that credit is not about optimization for these folks that are in this borrowing demographic in this FICO range. It's about survival. So the absence of credit is not a neutral policy outcome. It's a decision that leads to cascading consequences. Whatever category you're in, there are options available to get you into those higher categories, those higher tiers. It's not all is lost. There's always hope.
With the deep subprime,
Yeah.
a lot of these people go to these title places to get these title loans, right?
Check cashing services.
Oh, it's outrageous. The number of people that pay for these cashier's checks to pay rent or they use a check cashing company for as their bank. It's this black hole of fees, and they never, ever dig out. Now, it's never as you just mentioned, it doesn't mean they can't dig out. They just don't know how to dig out, right?
Sure.
And the best part about our credit system is I don't care if you have a foreclosure, bankruptcy, 50 late payments, you can get to a 720 credit score in 12 to 24 months. Just people don't know how to do it. But I love this visual of building up through the secret tiers.
Sure. Yeah. So on that note, though, we talked about check cashing services. I mean, I specifically want to identify the fact that a lot of the borrowing demographic in that deep subprime tier, they don't have access to even mainstream checking accounts. They don't have access to savings accounts. They don't have access to checking accounts. They don't have access to banks. They don't have access to credit unions. And whether that is by choice, they just don't trust the mainstream institutions, which I understand. I appreciate that perspective. Or if it's because of a financial circumstance, they were put into that demographic, that tier, that deep subprime category as a result of financial circumstance, whether it's bankruptcy, whether it's divorce, whatever, whether it's over leveraging their available credit. They're in this demographic, and we got to recognize that these people just don't use traditional mainstream financial products that a lot of us take for granted every day.
Well, they don't use them, but they have they have access to them. They just don't use them for like the reasons you said.
Well, some people
They
don't
don't.
even have access to them.
But why wouldn't they have access to them?
So there's capabilities for banks to reject checking account
Mhm.
applications. There are circumstances where an individual might not even be able to qualify for checking accounts at the tier 2 institutions.
So let's unpack that. What would those be?
Serious past delinquency, known habit of writing bad checks. So like credit bureaus for credit.
Mhm.
Everybody knows the tri-bureaus. There's Experian, there's Equifax, and there's TransUnion. There are bureaus for mainstream banking products like checking accounts and savings accounts. Those bureaus also report fraudulent or questionable banking activity. And any questionable banking activity using checking accounts previously that stays on your history for quite some time and could preclude you from being able to qualify for something as simple as a checking or a savings account.
I've just never experienced someone who's never been able to do it. Now, don't get me wrong. If someone is committed by maybe they're prosecuted and they have a lot of fraud, I don't come across that often. But like I understand the fraudulent checking, writing that
Sometimes
out.
it's just criminal activity
Yeah, okay,
that
criminal.
typically, yeah.
Okay, so but I mean, even the criminal activity, at some point, there's gotta be a rebuilding process. I mean, like, gotta be. I mean, even if they limit it at some point, right? I mean, what does that look like? You're
Well,
talking like
look, if you're trying to apply for a checking account and you're an immigrant and you don't have identification,
mhm.
that's a method for not being able to get access to typical checking and savings accounts too.
Well, what the immigrants do is they go and they apply for what's called an ITIN number, right?
Sure.
And with an ITIN number, they can open up a checking account. But I mean, but so the immigrants is easy, but it's the criminal activity that I just I don't come across that often. I have heard of people not being able to get approved at like a top tier bank, but I've always seen them get approved secondarily, but I don't know about it from a criminal perspective. That's interesting.
That's the only reticent example that I can think of that might definitively bar someone from mainstream banking
Yeah.
in a way that's really truly out of their control. So, quick reference for the audience. Let's go back through all the tiers. Tier 1, super prime, 760 to 850 FICO. Prime, 680 to 759. Near prime, 620 to 679. Subprime, 580 to 619. And then deep subprime is anything below 580.
Wonderful. Patrick, thanks for your time.
Thank you.